What's up, guys? Welcome to another Market Radar podcast. We've closed the second week of CHOP. Markets really have not gone anywhere, but so far, year to date, these four indexes are still green. NQ leading the charge as usual. Let's take a look at the calendar for next week. Next week, Tuesday, we've got PMI and existing home sales. Wednesday, we've got FOMC minutes. It's going to be a big day. Market tends to react on minutes quite a bit. And then we've got GDP. So Wednesday and Thursday are the two main days you want to be looking out for. GDP, we want to see, is the market still hot? Which it is. That's I'm just going to say that right now. It is. Growth is still on the upside as the market has been pricing. And we'll see what GDP numbers do to the market pricing. But so far, growth remains strong. And Friday, we've got a few events, but nothing too crazy. So main days, Wednesday and Thursday, that you want to be looking out for. Today's topic that we want to talk about is the big flip. I'm not sure if you've heard of it. If you're around on Twitter quite a bit, you must have seen it. The big flip, coined by Carlo Cassio, or whatever his name is. And it's a theory that's been floating around. It's really hard to understand the full scope of the theory, but from some digging that we did before this podcast, we took three things away from it. Three things that are definite parts of the big flip. And that is a prediction of dollar up, rates up, and inflation up. So we're going to address all three of those components because those are the only things that we believe are really part of the theory. There's other people tweeting out about, oh, this is the big flip. Here's the big flip explained. This is what Cassio is talking about. But they tend to all say different things. So these are the three things from Cassio, his theory, which, that guy talks in cryptic languages, so that alone is a pretty big red flag, and it's really difficult to follow what he says. But these are the three things that we're going to address, which we know are for sure part of his theory. So, Gamma, you want to start us off with inflation up, and what are our thoughts on that?
Right. So let's start with the inflation rate, with the CPI numbers, which we got this week, showing the year-over-year rate at 6.4%. So down. Not obviously the rate of change on the way down has been, or seems to have slowed a little bit. Right. We've come off of 9 we've come from 9 in the last 6 months rather quickly, and now we're slowing down. Now, what we've noticed, and we've been speaking about this, outside, let's put the big flip aside, right? So the big flip, this whole idea that inflation is going to go back up, rates are going to go back up. In terms of talking about where the Fed is going to go, we've been saying for a while that the back end of the Fed curve has upside risk. Okay, I don't know how many times I can pound the table on this, but literally the rate cuts that were being priced in just a few weeks ago, or even let's go back a month ago, are being erased on the back end of the curve. So if we go to look at, let's just say, January of 2023, we were seeing some expected rate cuts. Those are starting to lift and basically get erased. And we'll go over that in a little bit more in detail in a few minutes. But let's talk about where the terminal is, or the peak Fed funds rate right now. So it's expected with the curve that we're seeing this weekend to peak in September of 2023. So we're looking at 5.3%, or 530 basis point terminal in September of 2023. The current inflation rate is 6.4. So if we take a look on what's been developing here in the inflation market, right, or the inflation narrative, is inflation's off the highs with the Fed pretty much yanking rates up. We're talking about one of the fastest rate hiking cycles we've ever seen. Okay. We have the Fed funds rate at 433 basis points. Literally a year ago, we were at or close to zero. So this is making headway here at a drastic rate. Now we're expected to go all the way up to 530 basis points in the next 7 months or so. Now, the question here is going to be where inflation goes in that time period. So the part of the big flip is this idea that inflation is going to bounce. And we've also been saying that inflation has some upside risk. But I don't think that there's a lot of weight to be put on the idea that inflation is going to break the prior peak. Given number one, the Fed is very aggressive. Okay. You have to understand that the Fed is not, this is not the rabbit race of inflation versus the turtle race being the Fed, right? The Fed is coming up and fast at some of the hardest paces we've ever seen. So the 530 basis point terminal, which has been going up, it was under 500 just a few weeks ago. So like the idea that this Fed peak rates, that's bouncing. We didn't say that, or we haven't been so adamant about this higher terminal. We've been very adamant on the idea that the Fed is not going to cut rates quickly. The Fed's not going to waste their recession fighting ability on no recession, which again we've yet to see. More on that in a little bit. But let's talk about the inflation going up. For inflation to really accelerate higher and go up past its prior peak of 9% or almost 9.5 or whatever you want to round it up to, 9.5% year over year, for it to really accelerate above there, you're going to need to have the inflation index, right? Because this is what it's measuring. It's measuring the year over year change on the index really accelerate more. And I have that up over here. And as you can see, this is the January print. And if we compare that to the, let's put a vertical line here. So what we're measuring here is January to January, right? So for this rate of change of inflation that we were just talking about, for that to really start accelerating higher past its peak, we need to basically have a more exponential curve than what we were seeing back here when inflation peaked in June 2022. This type of move, we need more vertical. Basically, we need more speed up. So,
right. So like the slope needs to go back to the slope that we had during the peak of the recession. The peak of the inflation that we've experienced.
Exactly. Now, if we don't get that alone is we're not going to get this inflationary print higher than where we were. Now, this isn't to say that inflation can't remain sticky. We can definitely chop around in this area. But the argument with the big flip is that rates are going to go up because inflation's going to go up and the dollar's going to go up, right? That's what we explained. So obviously, I think the inflation going up is not so much a risk of how high. It's more of a risk of how long the Fed's going to have to hold.
Right. Well, something I want to add as well is part of this theory from Casio is also that rates are going to go up. The terminal is going to go up to about 6%. So he's saying just another 50 basis points higher than the current terminal, roughly, is what he's saying.
Right. So that's also something we can add to the equation, because remember this, the way inflation is measured, there's base effects, right? Which are going to weigh on future performance, meaning, and to simplify what that means for those that aren't paying attention or don't know what the base effect term is or the definition of base effects, what I just said earlier, for inflation to just remain the same, right? The same as it is right now, the same move has to happen in the next 12 months, which is unlikely, right? Especially at such a high rate of change. Like things are going to start to slow down, especially given the Fed is moving the fastest it has pretty much ever done, right? Or the Fed is hiking at the fastest rates we've ever seen. It's going to weigh there's a delay effect, of course, but it's going to weigh on inflation at some point, and it's going to prevent inflation from really running away. Now, the argument is, okay, yeah, we're still not above the inflation rate. Now, the Fed is obviously, from their terms of real rate policy, they're going to want to see their Fed funds rate at or above the rate of inflation to really grab inflation or basically lasso it under control. If they don't get above there, I could see it. I could see the market taking it as like the Fed hasn't grasped inflation under control. Think of it like the water line. Like, okay, once it's filled, the Fed pretty much has it under control. I think that's what everyone's looking for, and I think the Fed is trying to play the long game here. What they're doing is they're looking at the inflation market, obviously knowing that inflation is going to have some negative weight to it. They're hiking very fast. They don't want to over tighten, so they're basically trying to meet inflation in the middle. And I remember just a few months ago, maybe 6 months ago, we were talking about like the Fed's not going to 9%. Remember that?
Right.
We were talking like they're going to meet in the middle somewhere. I mean, we've said that phrase multiple times throughout the podcast. And where I'm going with that is they are trying to get the terminal up high enough to where, the base effects alone from the CPI prints will bring them together. They don't have to chase inflation, nor is inflation going to just fall to zero. So they kind of want to meet in the middle, hold the rates for as long as they can until an actual recession emerges. Now, let's go on to the next part, into what happened in markets this week. Obviously, markets have been bullish for some time now, for the whole month, and we were seeing some weakness, but they closed the week buying up off the lows, and you can just tell that something, at least something from a feelings perspective. Now, we don't really use feelings; we like to use numbers, but if you throw all the other stuff or push it all aside, you can almost have this feeling that something has shifted. It's
Right.
no longer what it used to feel like. The economic releases, again, we had inflation bounce above consensus. They did reweight in the inflationary, the rate over change numbers, the rate of change metrics of the way they're measuring it. They did update that. So inflation did come in above consensus, but it was almost expected, right, to a degree. Now, the market did sell off on Tuesday a bit, but again, we're not getting that type of, like, this was just a few months ago with the inflation, right? The inflationary numbers, we had wicked moves in the market.
Right. Now there's just so much more liquidity, it feels like.
Right.
And like every dip is being bought up. Every time the market sells off hard before the close, we get bought back up. There's definitely a change in the environment.
Right. Now, obviously, this can change too, right? This type of environment, we can go back to risk off. It can happen. We have to be on our toes, watching and listening to what the market's telling us, and just take action as soon as we can see it the most efficient way. That's really all we can do. But let's go to bonds next. That's another thing. I remember we had this whole analysis we did going into the Fed meeting. Basically, what we were seeing with bonds,
well, the action with bonds as well, without them breaking out, that was the clear telltale sign to us that inflation does have further upside risk.
Right. And remember what I said earlier, there's a difference between inflation having upside risk and inflation breaking out, right? Because all that has to happen for inflation upside risk is literally a higher than expected reversion to the mean. So think of it like all these economists, and if I could draw a dot chart, think of all these dots going down. Like, that's what they're basically saying. Like, that's what people are thinking, like 2-3% end of the year, right? Type of like move lower. Now, all that inflation upside risk is that curve gets pushed out and up, meaning I'm not saying we're going to go to 10, 15, 20%. That's not what that is implying with upside risk and inflation. I'm implying that inflation when I say inflation has upside risk, it has upside risk from where it's expected to be in the future, meaning it's stickier than expected. So obviously bonds were pricing in, bonds and the Fed curve, the Fed forwards curve, or what we call our Fed forecast, was pricing in rate cuts already by the end of the year. And this, not only did the bond market kind of hold back from it, but the Fed was very adamant in clearly stating that they will not cut rates. They pretty much said that over and over again, saying that they don't expect to see rate cuts at all in 2023. And the bond market was basically calling the Fed's bluff. Now, what most people don't understand is the Fed controls the bond market. Obviously, we know when in terms of smartest money, the bond market is the smarter money over equities, right? There's more money trading in bonds. It's considered the smarter money, but that's still controlled by the Fed. If the Fed decided to raise interest rates right now to 7%, bonds are not pricing that in. If the Fed decided to raise the interest rates right now to 20% on a Fed funds rate, bonds are not pricing that in. Bonds will move drastically lower. Rates will go up drastically higher because the bond market is not predicting the Fed to do that. But at the end, the Fed controls the bond market. Now, they'll battle closely, and I have a couple of tweets about this, but long story short, the bond market will front run the Fed when they expect the Fed to start moving. The bond market's not going to move and the Fed's like, oh, shoot, the bond market's moving, we got to move. That's not how it works. The bond market will front run the Fed. So Obviously, the bond market was expecting the Fed to cut, which is why we were off lows, we were going up. But the confidence in that front running action the bond was showing us was not strong. Obviously, we were not above the December highs back in early February. We were triple topping here. You can use some technical analysis, but that's really outside the question. If we just look at CPI releases, each CPI release, basically, the bond market wasn't, long bonds weren't moving higher. And if you expect this whole inflation to fall like a rock, well, then all these prints should be much higher from here, but they're not. Right. So that's something that we were watching. We call that pretty much spot on here with the bonds going down and the back end of the Fed funds rate coming up. So far, so good there. But let's move on to the next part here, which is the dollar. Right.
Yeah. So the dollar is the one thing we don't agree with about this whole big flip theory. So inflation up, rates up, totally agree with that. The dollar, this is the one thing that we don't believe is going to peak again.
Right. So let's go over what really powered this dollar move up. Right. So some would say it's rate hikes, right? Yes, and to a degree, rate hikes did power that. Obviously, you're increasing the Fed funds rate. You're constricting the supply of money. Quantitative tightening to a degree, rate dollar goes up. But in terms of the world, if we take a look at the difference here, okay, let's plot. What we have up here is the Eurozone interest, and the reason we're going to use the Eurozone is because it's 57, almost 60% of the dollar index. So if we take the Eurozone interest rate minus the Eurozone inflation rate, so it's basically the ECB rate minus the Euro inflation rate, and that would give us the relative real yield from the Fed's perspective, right? The Fed's a positive real yield environment is where their Fed funds rate is above the inflation rate, or the ECB's rate is above their Eurozone inflation rate, and we subtract that from the Fed. So the Fed funds rate minus the U.S. inflation rate, we're going to get the differential between those real central bank yields from Euro to Fed, and that's plotted here in orange. Okay, as you can see, back in January of 2022, this thing falls off a cliff, and it peaked in May of 2021. Now, if we look at the dollar, notice May of 2021. January 2022, we peak in, we fall off a cliff January 2022. So if we go back to the dollar, January 2022, look what happens. We fall off a cliff. Obviously, what this is showing you is the yield is more competitive in America compared to, let's raise this up a bar. The battle between central banks, the United States is winning in terms of being more aggressive.
Right. Okay. So it's all relative with each other. So
right.
The larger the discrepancy between them, the larger the dollar moves you're going to see.
Right. And now what I have overlaid here in blue is the euro price. Now just remember, euro up, dollar down, it's 56 or 60% of it roughly, right? So euro going down, as we see here, is dollar bullish. Euro going up is dollar bearish. Now, what you can see on the chart below here is each central bank's rate. So yellow, we have the Fed, and blue, we have the euro. Now you can see the ECB. Now you can see the ECB is much further behind the Fed, right? We're talking over 150 basis points behind the Fed. And the Fed's terminal is their terminals are respectively also much different. Now, if we look at the, call it the battle of the banks here with this orange line, you'll see that the euro is 3.6, call it points, right? 3.6, 3.7 points behind the Fed. Meaning, if the Fed gets to inflation and they hold inflation and inflation drops, or let's just say it's neutralized, right? So the Fed meets the inflation rate with a flat differential, meaning the Fed funds rate and the inflation rate are the same. Well, the euro still has to, they just had inflation. We can pull that up right here. So euro, inflation rate, right? So let's just look at their year-over-year rate. They're at 8.5%. And this is with the euro on the bottom. So look how far they have to go compared to the Fed. they have much further to go. I mean, this is 3. It's because of the way the print is, but you get what I'm saying, right? So the euro has a much more battleground to cover compared to where the Fed is right now in their situation. And what if we look at the chart here, to call it the orange, the battle of the banks, like I said, the euro is going to have to do some work here. So what's going to happen is if the euro goes and combats inflation just like the Fed or remotely close to it, what they're going to do is they're going to push this orange line higher. The euro is going to start picking up where they've been losing, which is negative, right? Because the Fed's been winning. Remember, so we look at the equation. You just think of it like this: ECB minus Fed. If this number is negative, the Fed is stronger than the ECB. That's how we're getting a negative. So if the ECB picks up some of the weight or their baggage and starts pulling, this is going to revert higher. Now, you can see here over time, it's not an exact correlation, but they generally move together, right? So like as this orange line goes down, and we'll make this full screen.
Well, so isn't the argument that the euro can't raise rates too high, otherwise they're going to crush a few of their countries?
That is the argument, and we'll go back to, we made a whole video on the euro, and I do think long term the euro is faulted for that reason. Now, they're going to have to raise rates to a certain degree, because otherwise you're going to just let inflation run rampant, right? Like if you don't tighten the economy, then what happens with inflation? It's perpetual, right? It just gets bigger and bigger. People just expect more and more price hikes, nothing to stop. And I'm not saying the ECB is going to be as quick. Well, let me put it to you this way. The ECB may not be able to act as quickly as the Fed or even to the same degree. And inflation does have base effects, right? So like, as we explained earlier, as long as the ECB is adding some fire or fuel to the fire of fighting inflation, they should revert this differential here. And maybe it's not going to go back to where it was up here, right? But them reverting this differential should add some fuel to the euro. Now, what that's going to do is that's going to weigh on dollar performance.
Right.
Okay? Because as the euro demand, and let's just look at euro from here, if we take a look at the trend, euro has been bullish trend for some time. Now, I'll say this again. I don't think the euro is like, this is going to be the all-time bottom of the euro. Oh, euro saved. Like, okay, this is great. I think the euro has some very serious faults, but it's like those in the macro space, you have to understand, and a lot of people don't when they look at macro concepts. The faults that exist today may not be a problem tomorrow. And what I mean by that is, just because the euro has all these downsides doesn't mean the euro can't rally. It can't go up, right? It can't. The euro, just before going into this, the euro was at 125, 124, 123, right? The euro can go to 115. Could happen. It's bullish trend. It can go back to the highs. But what I'm trying to say is, like, the euro isn't out of the in the clear, obviously, but they have some wind in their sails now as the Fed starts slow. So the Fed's going to start slowing their rate. Like, we're only expecting a 530 basis point terminal right now. Maybe it's a little bit higher. Maybe it's a little bit lower. But where I'm going with this, and I guess this is a great way to simplify the point, is what we just saw in the Fed funds rate going from 0 to 430. It's not like the Fed's going to go, like, if we were to take a straight line, right?
Right. Like, they're not going to do that again, right?
Right. It's
they're
not like
going to continue at that pace.
Right. At that pace, the Fed funds rate by the end of the year will be 10%. That's not that's I don't think that this path of trajectory is even remotely stable or sustainable, right? So that's going to slow down. But we knew that. The market knows that. We've been pricing that in. The market's been pricing that. We've been seeing it for some time. So if that rate of acceleration is going to slow to a degree, right? Obviously, we know they're going to still fight inflation. Inflation remains sticky, but we don't also believe inflation is going to go to new highs in that manner. Then one side of this equation that we were talking about is going to slow, while the other side still has to work. Reverting, call it the battle of the banks, towards zero or closer to zero. Now, what's going to happen is it's going to bolster the euro, at least for the short term. In turn, it's going to weigh on dollar performance. It's going to prevent the dollar from pretty much going back to the highs where it was the hawkish guy on the street. Call it the hawkest guy on the street, right?
Right.
Literally the most hawkish on the street. So I don't see how that's going to continue, given that their policy path is going to slow to a degree. Now, in that case, for the dollar to go back up there, I think we would need to see a real acceleration from the Fed beyond the 530 basis points. I'm talking much higher.
Like we need inflation to go back up to the peak to see that.
Yeah, we need to see the Fed like really just ramp up higher. And we would need to see that on a global level.
Right.
Like we would need to see inflation really take off. You almost have to say exponentially at this point for the dollar to really get back up there.
For that to happen, you pretty much have to assume that everything they've done so far did not work.
Right, which we also know there's a lag effect to that, right? The Fed hikes so fast in such a short period of time, it's going to seep in slowly as time progresses. So we have to take a bird's eye view here and say, what obviously a real recession, like a deflationary environment, will be great for the dollar. Now, if we start to see that happen, maybe we are at the point of pivoting from this rebound into an actual recession. That'll be different, right? But in terms of where the dollar is going, for it to go up to these highs at this point in time, lots have to change. We are actually, if you really think about it, the dollar would have to get to Momo, break Momo, go up, go bullish trend to really get us, to really prove our point wrong. But where we stand today, the system would pretty much almost guaranteed the system would have already pivoted much earlier than those occurrences coming to fruition. So it's almost basically it's an invalidated point, right? Like we can argue like, okay, the dollar won't go up, but if the dollar does, obviously we will be out of our current positioning well before that happens, before the dollar even gets remotely close to the peak. But in terms of us seeing it as a probability, no, I don't see the dollar going up.
There needs to be new information coming in.
Yeah.
For anything to change. Current information, the dollar bullish trend is just the odds are against it. The odds are stacked against it.
I literally had a tweet go out to Santiago capitalist guy. I think his name's Brent, right? Brett. I think his name's Brent. Back here in November, dollar moved down, claimed dollar still bullish, and I literally said, dollar's going bearish trend. We gotta respect the trend. It's it could go. I literally said the math checks out, but the trend's not right. So the dollar can still very well go higher over time. But we're not here. We're not making decade investments here in the dollar, right? This is not what we're doing. We're timing shorter trend market, shorter term markets via the trends and whatnot. So if the dollar remains bearish trend, it has downside risk. Just like when we were looking at ES this whole year, right? Bearish trends tend to lead to lower prices. Every time we rallied, we said bearish trends, downside risk. Downside risk. Dollar has equities have downside risk. Same thing with bonds. Bearish trend, downside risk, and until the trend ends, the downside risk remains. So to sum this up, dollar has downside risk. This whole reason for upside risk, from a macro perspective, we're not seeing that remotely come to fruition. We got ECB headwinds here now for the dollar. And from a trend perspective, I mean, obviously you can see there's no real, it's not like we're at Momo, we're teetering with the trend, like saying, oh, you know what? Dollar could go. Like we could be wrong. As of right now, the dollar goes up to Momo, I'd expect it to bounce off and be a fade at this point. There's no reason for me to be dollar bullish. Unless the system were to indicate to us that there's a risk on environment or impending risk on environment, then we'd have to take some caution for any potential dollar move into bullish territory to be taken, obviously as a material trend shift. Until that happens, pay attention, follow the regimes step by step, day by day, and as we always say, no model, nobody, no theory, or no person is going to be sharp 100% of the time. We will get things wrong. You will get things wrong. Everybody will get things wrong at some point. The only question is getting things wrong at a lower amount than you're getting the things right and making headwind over time and compounding your gains. So we've called the move in real yields right. We've called the move the fake pumps in gold right. We've called the move in bonds right. We're we've called the move all last year in equities going down, right? So we have to take this, obviously, and this is not me being pompous in any way, but we have to look at it like this. Make your calls, look at the picture, place your bets. Done. If you're wrong, wipe the board, keep moving. Don't sit there and play this whole idea of narratives, right? Because that's really where people get hung up on, this idea that the dollar has to go up because of XYZ. You believe in XYZ, dollar has to go up. Now, this can be said to the dollar milkshake theory, right? The dollar milkshake theory wouldn't have let you say the dollar could have gone bearish trend. There's no bearish trend in the dollar milkshake theory. It just goes up, right? Because the idea, the narrative and macro thesis is that dollar will explode higher, and that's where people end up holding the bag. You can go back here, right? Now you might say, "Oh, this whole period where the dollar went lower, dollar milkshake theory. What happened to that?" Yeah, you held the bag. Now, obviously, you're up, but now you're going to hold the bag again. So the question is how long are you willing to hold bags, sit around, and really be wrong? Because these types of bearish trends, you're not just down or temporarily not make your call is wrong, and at some point it could be right again, but that's not what the game we're playing here. So throw the narratives in the garbage. They will not. They, over the long term, you will end up losing more money than you will make on those narratives. And I think people, they'll watch the movie like The Big Short, right? They'll watch Michael Burry and his narrative on the 2008 financial crisis, and I think what they do is they say, that's how you get conviction. You look at, and the reason I'm using The Big Short is it's such a commercialized movie that pretty much almost everyone that remotely looks at markets has seen that movie. It's got Christian Bale, so obviously a lot of people have seen that movie. So I'm anchoring on that. But they look at that and they say the man had conviction. The market was going up in his face. He literally said no, bull, average down, hold. I will not fold. This whole type of mentality because he had his narrative or his thesis. Now, that does not have that you're talking about 1 in a million right there. That's not how that works. Usually people get blown up well before they get to see their endpoint of their narrative. And most of the time the narrative doesn't even play out. Like let's go back to SPY and COVID, right? This whole idea, the amount of people that said we can't get a positive economy out of this. Government shut down, people unemployed. The whole thing was massive layoffs. Economy's broken, and things are never going to be the same again. And we literally got one of the best bull markets you could have possibly seen.
I think a big mistake that people make is they do not know how to react to new information. They create their narrative off of current information. New info comes in, which should be changing their narrative, but they stay convicted. They stay true to that narrative. No, this is it. This is right. And they do not act on any new information that comes in.
Exactly. And just like I said earlier, the dollar peak seems extremely likely right now. The dollar has peaked for at least the short term in terms of what we're in short-term markets. If there is new information that indicates the dollar may have not peaked, well, a really solid sign would be bullish trend. So that's before the dollar peak. It's not like I'm sitting here saying, oh, the dollar's peaked now, I think, or the dollar is 1% away from its new all-time highs. I think the dollar may have not peaked. That's not what we're not saying that either, right? But you have to have some middle ground. You have to have double checks and balances. We have the system, which is our economic model. And then we have the DDAP, which is our trend model. They both get mushed together and give us our models, like our portfolio models, which guide us throughout markets. Now, obviously, we don't see any upside risk for the dollar at the moment, at least in terms of trend, maybe to Momo, but that's not significant for us. And until we do see some upside risk, obviously, it's bearish trend. It's going to have downside risk, and that's just a game we play. We've been playing this for a while now. We've been telling everyone when things are bullish, they have upside risk. When things are bearish, they have downside risk, and just stick with the trends. And I think that's where we'll wrap up this podcast, and we'll talk to you guys next week.